If you've come to this video, it's probably because you're still looking for how to understand and correctly detect market structure to then trade properly and directionally for better results. How many videos have you watched on the same topic? How many videos do you think exist on the subject? Let me tell you, it's not your fault. Unfortunately, it's what most people do. Consuming video after video that promises to teach you the best way to trade is because you have mistaken the idea that trading is about knowledge when, in reality, it's a skill. I've been trading for over 15 years, and in this video, I'll help you realize that there is a structure that can help you make simple and objective decisions. However, it's not the subjective structure of smart money or other technical analysis. I assure you that you'll see trading in a completely different way that no one else teaches and no one else had understood. This way, you can compare taking action based on a subjective structure versus making decisions based on an objective structure. First, let's understand what structure is. The word leads us to the Latin structura, which means the arrangement and order of parts within a whole. Everything around us needs a structure. Within our bodies, we have the bone structure enabling all other organs, muscles, and subsystems to function. The place you live in needs a structure to build rooms, install plumbing, roofing, and many other physical aspects of the house. We also have mental structures that help conceptualize and organize content of intangible ideas. Your religious beliefs have a structure. The way most people teach trading has a structure. As a consumer of trading, the key is to understand not only the technical structure but also the ideological structure of why most believe what they believe and, therefore, teach what they teach. The trading chart in any financial market also has a neat structure. But what I'll show you in the next trading simulation in this video is that there's a popular structure that most accept and limit themselves to, and the objective numerical structure that most don't understand. This structure isn't limiting, it provides objectivity, flexibility, and adaptability to follow the price and the manipulation processes of the banks. In the next part of the video, I'll show you one of many ways to trade the markets without using subjective structures derived from smart monkey, institutional trading, Elliott wave technical analysis, or any other ideology you might know. Furthermore, your profitability can be higher because you're not restricted by the subjective parameters derived from subjective structures. You can have a much more adaptive and simple trading approach more in tune with the true business model of banks and institutions and their high-frequency algorithms. So, let's begin a new simulation with $1,000 and apply leverage of 150, not because we need the leverage, but to give you more margin and make it easier for you to enter trades. Let's go to December 2014. We paused in December 2013 because I'm making these videos in December. And these are the months many people are afraid of trading in December, because in December usually there is less volatility, etc. As you can see here, unlike before, the risk is now in percentage, not in lots, and we're putting 2%. Starting the simulation, and I'm applying this FX template. I'll start making trades that I don't need to explain. The detail of the subjective structure, looking at highs, higher highs, lows, and lower lows, is something most people usually teach. But the reality is that it's nothing more than the trend of technical analysis. Highs, higher highs, lows, higher lows, and previously lower lows. This is a structure that most people use to start making directional decisions in the market. However, I want you to notice I'm placing pending orders, but regardless of the size, each order I'm placing has a 2% risk. You can see on the left side how the lots are different. Some entries have, for example, 0.09 lots. Others have 0.07. The important thing here is risk management, not so much why I'm entering or having a notion of the correct structure. Because you can see that the price went up, remove the previous high, and this would be a change in structure. Then you have to consider other things and wait for the market to make certain retracements, reach a level, and all these things that are part of trying to find structure. As I mentioned at the beginning, everything is structure. Everything needs structure to build upon. The problem is, why do you think it's challenging for you to find that structure? Why do you think you keep consuming videos and constant content comes out on how to find the best structure and what the market structure is? It becomes a repetitive process, assuming that this is the structure and then it's the right way. That's how you start trying to build your own trading actions, where to buy, where to place to stop, where's the best entry, the best exit, the best imbalance, and all those things. You can see that I'm placing pending orders for both buy and sell, and the price is moving. This is a simulation. It's the first time I'm doing it this month. But when you already have the notion of the basics, time, price, probabilities, and manipulation, which is what the big players do, they accumulate money, they accumulate orders, similar to what I'm doing. I'm also accumulating orders, placing them on the chart as the price moves. When you have the foundation of any strategy, it gives you an idea of how to place them. An important part of this is that it doesn't matter where I'm placing the pending orders. They are fully measured in terms of specific risk. It's important to stay tuned, see what happens, where this account ends up at the end of the month, but also at the end of the video. I'll show you the video where I've talked about this so you can delve deeper and realize that the structure I'm using, based on time and price, is the same for everyone. The problem is that understanding it this way is more challenging because the subjective structure is much easier to teach, much easier to remember because it's being compared to some structure you know in the outside world. But the structure we are applying here is based on independent entities. Most structures in any system, strategy, method are based on a network or layered system. What does this mean? I need the price to do this first, then this, and then this. This is a layered system, like any layer. If you're doing any kind of work, for example, you need the first step to be done. You can't do step 2 and step 1 simultaneously. So, step 3 can't happen if steps 1 and 2 are not done. So, that's a layered system. And this is because what most people seek between the lines is to find an organized system, a fixed system. So, it's easier to say, look, step 1, do this, step 2, it's this structure breakdown, and we'll see the market do this and that. The problem with this is that you're not considering the randomness of the markets. Remember, at the end of the video, I'll let you know where you can delve much deeper into a video I've already made and why I'm doing what I'm doing. As you can see, I'm placing pending orders, and this in itself is an accumulation. You have to understand first and think about it. Do you think banks are going to use a subjective structure of higher highs and then lower lows? Or are they really, thanks to the information they have, able to see where the accumulation of orders are over time, over the week, over the month, over the days, hours, and then this allows them to maneuver in their money injection? The price goes up, the price goes down where they need the price to go because there's a series of order accumulation that they can use or remove before starting to move in another direction. Or they are trying to accumulate orders in one direction so they can then buy and go for all the positions on the other side. So, do you think their high-frequency algorithms will be programmed based on a subjective structure of forms and mezzanines, or will it be programmed through a numerical structure? Think about it. If it's based on a numerical structure, high-frequency algorithms will use. Then why would you have to study and consume videos from someone teaching you a subjective structure? I want you to understand this. I'm not saying, in fact, I'm making you understand that structure is part of trading. It's justifiable that all those people teaching you a structure, in fact, I applaud them. I applaud them for trying to teach you a structure and making decisions based on it. Probably for many of you, it's working and you're making a profit. What I want you to understand is that if we go beyond and break those paradigms, ideologies, that I've talked about in many videos and base yourself on a numerical and objective structure, your results will be much more exponential. Even the strategies you might be using and are working for you, it does mean you'll automatically replace them. They're still useful, but you'll exponentially understand the logic behind the true business model, which is accumulating orders, seeing where those orders are, injecting capital, injecting liquidity, going for that liquidity, etc., etc., and then repeat accumulation. And another important part you'll realize is understanding. In the end, like any business, banks have to accumulate orders, distribute profits, but at some point, they'll have to inject capital to go and collect them. That is, a business, for example, making t-shirts. You can't make t-shirts and keep accumulating fabric, ink, labels, accumulating. Eventually, you have to build the t-shirts, make them, and then sell them. Then go back to the process. You can't indefinitely accumulate something if you're not going to take advantage of what you've accumulated to make more money. So, understanding this logic, what I'm really doing is placing orders at certain points that I teach you to distinguish, but not in a subjective way but objectively. In other words, anything and everything of the boxes you see here are independent entities. At the end of the video, I'll tell you where I explain this in more detail, and see how those fundamentals are only going to be a pretext to go for all those orders that have been accumulated over time. And here's where the key and the difference come in. Instead of trying to decipher what the best order block is and what this structure is, and the imbalance and all those things, which are commendable but ultimately still part of the same raw material, which is technical analysis. If instead you start to understand that you can really use different points to follow the price, it will also help you understand how you could program this, because this is already a numerical structure. Unlike it being a subjective structure of look, let's see this pattern and this block and all those things that, in the end, would be very difficult to instruct a machine to detect all those subjective things. So you base yourself on numerical information, then what will happen is that you'll be able to have artificial intelligence that can execute for you. And all you do is manage the risk. All you do is, for example, turn on the expert, because now you have a more grounded notion of that structure on which every system method is based. What am I telling you with this? You realize that the principles of price are the father of every method, the father of the smart monkey, the father of institutional trading, of technical analysis or price action. If you start to understand how to make decisions based on an objective structure, then everything you build will have a solid foundation. Even in religion, Jesus told Peter, "Upon this rock I will build my church," right? What is that rock? Obviously, there's a lot of interpretation, but what I want you to realize is that to found something and start building something, you need something solid, something that doesn't change, something that's the same for everyone. Even for the banks, every structure, if it is well founded, then what you build on it, it could be many different things, doesn't limit you, doesn't have to be as someone else says. And it also gives you the option to have many different variables to build it and become a producer instead of just a consumer of trading ideologies. Now be a producer of simple adaptive methods built on your own financial, psychological, and circumstantial limitations. If you notice, here I am programming pending orders. I continue with that process, and as time passes, I continue programming other orders, but each one based on different independent entities that in the last video I nicknamed, or whatever name came to mind at that moment. Something I want to highlight is that if you notice, the risk is being distributed, which we know is 2% for each reference, no matter what it is. This way, my job is not to strive to deduce which is the best and overanalyze things, but to quantify the risk and distribute it. So, my entries don't depend on my correct decisions, but on an objective and numerical structure that is there with or without me. Here, for example, I can also enter the market and not necessarily with a pending order, if a distribution process is already being followed. Therefore, it's not a law that all entries must be pending. You can also enter the market as many times as you're in front of the chart and detect the natural conditions of numerical processes. An important aspect of this understanding is that previous entries are not in conflict with the future ones, as each entry is independent since it is based on an independent entity and not on a layers or network process, as in most trading systems. As the price moves, all pending orders will expire or be eliminated. I'll explain this process in another video, so don't forget to subscribe here. In addition to being able to adapt operationally to an objective and numerical structure, it allows you to understand and observe manipulation processes, because manipulation, in the end, is what causes most fixed systems to break and fixed parameters to change. If you realize these orders are somehow to adapt to the price movement in case it goes in the opposite direction. The reality for all of us is that we don't know if the price will go up or down, but the mental process of a brain free from ideologies and trained to react objectively in the present allows you to avoid getting married to a direction or a correct analysis, creating the opportunity for more exponential results, because you are acting with the reality that you don't know. Instead of forcing the market to believe what you think you know, there's a very important variable, which is frequency. If you notice, the word frequency means the repetition, whether greater or lesser, of an event. The reason high-frequency algorithms are so profitable and dominate trading operations today is that they leverage numerical, repetitive, and constant information to increase entry frequency and risk distribution. Here, you must understand that I can decide to increase or decrease the frequency of orders, and the results will be different. The key is that I am not limited to a sequence of subjective structure or compliance with subjective pattern connections or fixed parameters from the past. When training people, I help them experience which frequency is most suitable for them based on their personal limitations and also based on their risk acceptance. So, people are not forced to follow a strategy that is the same for everyone but can be adapted to different individual circumstances. Here, as you can see, I can also add orders to the market that will ultimately have their independent risk. The price can do whatever it wants. When the price retraces, these are opportunities to buy cheaper and at the same time prepare orders that the price will go after above the high of December 4th, since if the price reaches it, it will likely push more north, seeking a bunch of accumulated orders placed above that price. From all the people looking for the price to fall more to the south in the long term, Once the price extends north to reach the high of December 4th, the price scores a point and retraces. As I taught a long time ago, before it became fashionable with the name liquidity and imbalance, and with this you can also understand the manipulation process. For example, in this case at the beginning of the month, instead of projecting that the price takes liquidity and goes a lot of pips to the south with a very low stop, instead, the manipulation process gives us the notion that the price will continue to go north for a good time, thus taking advantage of the retracement movements to the south with cheap buys, a limit order, or stop orders to adapt to the upward movement of the price when it keeps rising. And I hope by now you realize that trading doesn't have to be confined to the limitation of strictly following a technical strategy, but having a clear understanding and plan on how to distribute that risk wisely and adaptively, taking into account the manipulation process. Thus, you're trading as an adaptive logic and not an unknown but academic and restrictive intelligence. If you notice, the price dropped or retraced a good distance to the south that I could have entered down. Of course, that is the key, that you can sell or buy following the price is what makes you enter down or up. It shouldn't be the ideological limit but the administrative limit of risk that you can consciously bear. Another thing I want you to notice is that, unlike what many do, which is to trade with martingale every time the price goes up, selling more as it goes up, selling more as it rises, selling more as it goes up, buying more as it goes down, it's not like that here. Every entry you see here has a stop and a profit, but their positions are versatile. They are not all in the same place, not at the same time, not in the same direction, not dependent on the same subjective sequencing, nor dependent on the same indicator. Like any finite process, there will come a time when banks will have to go and collect and recover what they have accumulated over time, injecting money in a direction, releasing the price that suits them best, creating an outcome, which we don't have to know which direction it will be. With this revolutionary way of understanding trading, what we do is adapt and let them themselves lead us to their intentions, whatever they may be. Once the process ends as they want it to, we start again. Knowing when you end and start a new cycle is a fundamental part of understanding the real system of banks and institutions. Most traders focus on isolated tactics called strategies, which mostly limit and condition them and make them feel enormous fear of disobeying them, since most of these are displaced from the objective reality of numerical processes of price. But if your approach changes and you break these popular paradigms and mental structures, your actions will be based on what the objective numerical structure and its processes show you, not on the limitations imposed by another individual worry if those parameters are the best or not. If you notice, this new cycle that is starting, we don't need to see the subjective structure of highs or lows from months or weeks ago, but to take into account where the price is in the present and then redistribute the entries in the objective numerical structure of price and time axles. Here you can see how a manipulation process is coming, and the price does not reach the buy stop orders that were above and begins to go down, if sell orders had not been distributed to take advantage of that downward movement. The key is that you can place them, already having a sense of a bearish bias, as the manipulation process derived from a fundamental announcement. Your brain is probably questioning, but why do I choose such and such an area to place orders? What's special about it? Why the stop there? Why limit here? Etc. And this is because unfortunately this industry has conditioned you to seek an answer to everything that happens on the chart. You, as a consumer, demand an answer because you have desire and fear. And most gurus, teachers, and training masters give you an answer, as if we could actually verify that this answer is true within experience. At first, you think that what they tell you is knowledge, and so you spend your time accumulating consumption of ideas and beliefs and not a true accumulation of logical and objective experience that leads to wisdom and self-control. This is the reason why then you search and search for some correct combination of the millions possible that exists, that leads you to the simplistic ideal of just strictly obeying the parameters set by a community that thinks collectively, hoping in this way to radically change your life with trading. Does this really make sense? Does it make sense to build a strategy on the subjective validation founded by others, even if they are called experts, masters, gurus, senseis? Or does it make more sense to base yourself on the objective, numerical structure of the price principles, which are the same for everyone and the parents of every method, strategy, or trading system? Remember, I recognize that there are many ways to succeed in trading. Many profitable systems exist even on the foundation of subjective validation. But at what cost? Do you want to trade calmly thanks to the objectivity of numerical processes that occur? Do you want to be stuck all the time on the chart looking for meanings? Do you prefer to feel anxious and uncomfortable because of the threat that your analysis may not come true or use losses as information in your favor? Do you prefer to continue doing hours of backtesting trying to find the ideal parameters? Or do you prefer to simulate hundreds and tens of months and years to confirm that numerical processes based on the principles of price have always been there, and then trade in real with more confidence? Do you prefer to continue consuming YouTube videos, joining groups, paying for courses, and depending on the subjective opinions of someone else? Or do you prefer to understand the principles of price that are the same for everyone, including the banks, and then never need to consume more trading ideologies or need anyone else's opinion to be free to make your own decisions? I stop the simulation here. December ends, and I want you to consider that these results will vary depending on the account amount, risk, entry frequency, stop sizes, risk-reward ratio, and also the times you can check the market. Something I want to show you is here. I have one of those $1,000 accounts that I showed you last time in the previous video. Now it already has 50%, and this expert I have is not based exactly on what I showed you in the simulation, but it's obviously based on the same fundamentals, objective numerical ones, and what it's doing. Here you can see that it doesn't have a stop loss because it's working in a way that obviously has a stop loss, but it's not a fixed stop, it's a floating one. So, what the expert does is understanding the logic I explained to you, but understanding not in a fixed and confined way to an ideological framework, but based on understanding the principles of the price. What this expert does is distribute entries at different points, and all I do is control it. Let's see the properties here, so I want you to check this data I have here, which is the limit and the maximum. If you notice, I have 15.0 as the maximum. It means that as soon as it reaches these additional $9 and reaches 15.0, the expert closes all positions and starts the cycle again. Just like the price, it starts accumulating losses. I'm telling it that if it drops to 13.0, it also closes everything, stops and waits until I instruct it again when to start the cycle. This way is one of the things you can do when you have the logic of numerical processes, because then you can not only distribute in an operation like I showed you, but you can distribute actions with the same pair, with the same instrument, and follow the price in different ways. So, not depending on a strategy and a subjective structure and worried about correct order or that the market retraces exactly to such an extent. It's liberating. Do you really want to learn to trade like an entrepreneur who manages the executions of others, or continue as a self-employed person who needs to be attentive all the time to the business? If not, it doesn't work for him. So that's why I always repeat to you, you trade with logos, trade with logic. Do you trade objectively by adapting to the business? Or do you trade subjectively trying to find the correct strategy, the correct ideology, the correct analysis, hoping that an individual who is highly susceptible to subjectivity and biases gives you the key or the holy grail, and you just think you have to obey it to radically change your life? In this video on my channel, you can delve deeper into what I did in this simulation that I showed you in this video and the logic behind it. You will understand what the real and numerical structure of price is, and you will understand why most trading ideologies cannot see it or use it. In the next video in this series, we will talk about liquidity, and you will be able to understand it in a more dynamic and simple way to not only be able to trade it in small time frames but also in large ones, and also realize that by combining them, you can have a better understanding of bank manipulation. Remember, we have training that helps you be free from trading beliefs and stop being a consumer of strategies, methods, and prepackaged systems by others, and you yourself become a producer of your own systems adapted to your personal and financial reality. So always stay focused on yourself and stop being distracted by what others think and do. So, enjoying your growth process like developing true experience and wisdom, which makes you have positive results. Contact me on WhatsApp directly. I leave the link below in the description, and follow me on other social networks. Remember, trade with logos, trade with logic. Until next time.